You know, one of the most commonly asked questions today is, where does interest come from in crypto? And like, you have to be very suspicious. If it seems too good, if the interest that you're being promised doesn't correspond to the risk that you're also being told that you're taking, you need to be very, very suspicious. In crypto and the broader crypto space, including those companies that pretend to be crypto type companies, interest comes from one of three ways. Either it comes from genuine economic activity. And for that, you need to think of like Uniswap, SushiSwap, or like Aave. And for those ones, you can see very clearly, like Uniswap and SushiSwap, those are exchange fees. Those are trading fees that are being shared with people that are putting up money to facilitate that. And that is very honest. Like that's a genuine economic activity where you're exchanging asset A for asset B, you're helping facilitate that, and you get paid, you call it interest, but really it's like a sharing of those trading fees. The next model that you have is essentially a model that is incentivized by tokens. And so that is, in my view, is a pure Ponzi scheme. And so that is something like Terra, and that's something where essentially you're getting paid interest, but it's interest not being paid in dollars or euros or whatever, that's being paid in the native token. And so you have to believe that that native token has value. And so interest is only as good as somebody else believing that native token makes sense to hold. Because otherwise, you're getting paid in nothing. It's like an emperor has no clothes type of approach to things. It's like, I will give you an economic value for this, but everybody has to believe that that token has economic value. And then the third way that you have interest essentially is like a mix of the two. So it's where there's genuine economic activity and there's also a token incentive. And you see that, for example, in Compound, where Compound was running a money market, which made a lot of economic sense. And then on top of that, it was like topped up with a token. And you see that also with Curve. And then you've got layers on top of Curve. So Curve itself makes a lot of economic sense. Things built on top of Curve are a total scam, a total Ponzi scheme. And because they're being paid essentially in like a native token. So those are the three different business models for crypto. And of course, like with Fluid Finance, we're in the first category. In Fluid Finance, essentially what we have is we have a model where we share our genuine trading fees with people that have like put money with us. So essentially our model is we're better than an exchange, we're better than a bank. And so what we do is we take the fees that we get from being a better exchange than Coinbase or Binance, and we share it with people who've come to us for banking services. It's like having a share. It's like participating in the revenue that's being generated by like Binance or Coinbase. It's just we're sharing it with everybody that puts money with us.